Okay, welcome to 10-4 Explain Preparing a Closing Entry. I've taken the liberty to just call up the list of the transactions. I've created T accounts for all of them, so I'm not going to journalize them for you, but I will be doing the graphic, and that should be enough to get you through this for sure and to explain it. So what do we have here? Well, we're going to identify the accounts affected, classify them, determine the increase, decrease, and find the debit, find credit, post to T account, and that's exactly what we're going to be doing here. We do know what account gets closed first, and we're going to say the very first account that gets closed is the revenue. And the revenue gets closed in the income summary, right? And then we have the expense accounts that get closed, and they get closed into the income summary. Well, then we have the income summary getting closed into the capital account. And then we have the withdrawals getting closed into the capital account. So with that said, we know which ones and what order that we're going to be doing them in. So, first transaction, it says record the closing entry for the equipment rentals. Well, I'm going to take a moment here and I'm going to put the balances for all of our temporary accounts, the revenue and the expenses and the withdrawals, including the capital. I'm going to take a minute and insert those balances, account balances. Okay, that was quick. So we have the balances for the revenue and the ad expense and the maintenance expense and the rent expense and the utilities expense and the withdrawal account. And we also pulled the capital balance over here. We pulled the capital balance right off of the of the worksheet. Right. So we take 19,775 right out of the capital and put that into our T account, because we're going to need that if we're going to be asked a question like that number 2 asks what the balances are for all these accounts. In any case, very first account that gets closed is going to be the revenue account. Revenue has in it a $14,965 credit balance. Well, if we're going to balance it out, we're going to need a debit. So $14,965. There is our first closing entry. And if that's our debit, we need our credit. What's it get closed into? Income summary. So $14,965. So there you go. There's our first transaction. The second one, we're going to be closing the 4 different expense accounts. We know that this is a compound account because we are closing more. Let's just say the transaction is affecting 3 or more accounts. Every transaction affects at least 2. So we're going to go with the advertising expense first. Has a $1,500 debit balance. Well, let's put the credit where it belongs. So there's your $1,500, and that's our second transaction. Here's another credit for $1,560. Still second transaction, and $1,000. Still our second transaction, and a $1,230. Still our second transaction. Well, we know that these are going to be 1, 2, 3, 4 different credits listed in a single transaction. Where is the debit going to come from? Well, we're going to take the sum total of all 4 of these accounts, which is $5,290, and create a debit of $5,290 into the income summary. So there is our second closing. And that closes out everything but the withdrawals. Now we're going to take the income summary, which is our third step. Remember, it's the third step. Well, what is the balance right now? Well, the balance is the difference between the debits and the credits. There's no such thing as a normal balance on the income summary. It's one of those accounts that doesn't care if it's a debit and doesn't care if it's a credit. And some days it feels like a debit and some days it feels like a credit. In this case, we know that the credits are higher with $14,965, and that's going, and we subtract from that the $5,290, and that's going to give us a balance. I'll put the balance in there, $9,675. Well, if we're going to close in step number 3, the income summary, we're going to need to close it for the amount of the account balance, which is a credit balance of $9,675. So we're going to take a debit of $9,675. It's just transaction number 3, right? And there's our debit. Well, it gets closed directly into our capital account. If that's our debit, well, here's our credit. $9,675, transaction number 3. That leaves us one last account, temporary account to be closed, and that will be the withdrawals. Withdrawals get closed directly into the capital. Right, it's the quickest way of devaluing your company is to take money out or have somebody quickly embezzle from you. Either way, it is a $2,350 debit balance. The closing transaction is going to have to be the balance of that, which is $2,350 in credit. So there's our 4th transaction. But that's our credit. Here's our debit, $2,350. And that's transaction number 4. In case it does ask you, well, let's go to the question over here. I hope I can do this. It's asking us to compute the balance of the capital after the closing entries have been posted. Well, we're looking for the balance of this account. Very simple. The normal balance side of a capital account is going to be the credit side. We add up all the credits. We subtract out any of the debits, because this is the decrease side. There's your decrease side. There's your increase side. And that should give you a balance of $27,100. So this is the balance. So that would be $27,100. I hope that explains it well enough for you. Go over the video one more time if you need to. We are at 7 minutes even, and we're going to call it. So that is 10-4, preparing closing entries explained.